Is Dave Ramsey wrong about bonds? Here's what 30 plus years of bond trading taught me. Did you know that some of the wealthiest investors in the world swear by bonds, yet Dave Ramsey tells you to stay away? In a brief video on YouTube, we'll link below, Dave Ramsey explains why he doesn't like bonds. Your first comment should be, "But Michael, that video was from a really long time ago." To which I would respond, "You're correct, but his actions speak way louder than his words." Search his channel for more information about bond investing, and you won't find much. Now let me step back for a second. I didn't make this video to hate on Dave Ramsey. He is spot on in helping people get on the right track with getting their financial houses in order. While Dave probably started investing in index-like funds long before me, he's a little older, I've been doing the same thing before he became famous, and it has served me well. However, Dave's just wrong about bonds. They can play a pivotal role in stabilizing an investment portfolio as your needs gradually move from one of growth to one where you actually need your investments to help you pay the bills. Today, we're going to debunk some major misconceptions about bond investing. Stick around. You might be surprised at what you learn. Alright, let's dive right in. We're going to look at 8 reasons why a popular financial commentator, Dave Ramsey's take on bonds is simply off the mark. 1. Misunderstanding bond types. Ramsey lumps all bonds together. There's a world of difference between bond mutual funds and bond ETFs and individual bonds. It's like comparing apples, oranges, and, well, bananas. Ramsey even mentions it in the video. There's a lot of volatility in bond mutual funds and bond ETFs. While the prices of individual bonds can fluctuate, unless you sell them, your interest payments are locked in and you'll receive your principal at maturity. That means if held to maturity, the individual bond is immune from market fluctuation, unless you need to sell them early when you could realize a loss or a gain. But the same goes for bond mutual funds and bond ETFs. You know what you're going to get and when you're going to get it. Someone we know seems to say that an awful lot. No, that's me. Next, ignoring predictable income. Individual bonds provide a steady, predictable income stream. Sort of like having a reliable tenant in a rental property. You know exactly how much is coming in and when. This can be incredibly valuable for retirees. While I love the prospect of getting growth in income from index fund, we can't just not eat for 18 months because the stock market is going through a rough patch. This is where I'm so surprised Dave doesn't discuss this more with his audience. I'm a believer in index funds, but they are not a one-size-fits-all cure for all of your financial challenges. It's also important to keep in mind that your bond mutual fund or ETF can go down in value, but can also cut the amount of interest that it's paying you. Barring a default by your bond issuers, your interest payments on an individual bond never changes, no matter what the Fed does, no matter what the bond market is doing. 3. Overlooking maturity guarantees. When you hold an individual bond to maturity, you get your principal back. This, surprisingly, is one of the most powerful parts of bond investing. You never know what your bond fund or ETF might be worth at any date in the future, so you could find yourself underwater for years in a mutual fund that has also cut the regular interest payments. 4. Misrepresenting interest rate risk. Yes, bond prices fluctuate with interest rates, but if you hold an individual bond to maturity, it's a non-issue. It's like ignoring the stock market's daily roller coaster if you're in it for the long haul. While Dave suggests that the bond market can be as volatile as the stock market, and he's not wrong. In my 30 plus years, I've seen some pretty crazy ups and downs. However, those ups and downs don't matter if you're holding your bonds to maturity. The discounted price in a higher interest rate market doesn't change your interest payments or your principal repayment. 5. Neglecting portfolio diversification. Bonds can act as a stabilizer in your investment portfolio, sort of like the shock absorbers on your car, smoothing out the bumps in the financial road. While all prices move up and down, investments like individual bonds that you bought to simply pay you some regular income and to pay back your principal, simply put, their market movement just doesn't matter. It may seem simple, and I've repeated it a couple times, but it's incredibly powerful. Back in 2008, during the financial crisis, I had a client who was about to retire. He had a significant portion of his portfolio in individual bonds, while his stock investments took a nosedive, His bonds kept paying interest like clockwork. He told me later it was the only thing that let him sleep at night during that turbulent time, and actually allowed him to retire in the time frame he had planned. Had he been completely invested in stocks, he estimates that it would have added another 5 to 7 years before he could have actually retired. Moving on to number 6, overlooking tax advantages. Certain bonds, like municipal bonds, offer tax benefits. It's like getting a discount on your tax bill. Uncle Sam's gift to bond investors. Don't underestimate the power of this tax savings. If you're in the 25% tax bracket and you buy a municipal bond that yields 4%, that's like getting 5.33% in, say, a corporate bond. If you're in a state that charges an income tax, let's say 8%, your 5.33% now becomes 5.8%. That's not terrible for a rate of return that, unless the municipality defaults, is almost guaranteed. As a side note, we've discussed on this channel before how low the default rates can be on munis, less than half of 1%. Moving on to number 7, overlooking corporate bonds. High quality corporate bonds can offer higher yields than government bonds with manageable risk. You're already investing in stocks of many of these high quality names as we see in the corporate bond market. These bonds can offer the stability I've been discussing throughout this video with a little more return than other bonds. Lastly, dismissing bonds for young investors. Even younger investors can benefit from the stability bonds provide. Here's a quick example. A guy I used to work with did all of the things Ramsey talks about. Maxed out his 401k contributions, saved additional money for rainy days, all of it. After several years in the industry, he decided to leave the firm he had worked at for almost 15 years. When he did that, his first move was to roll his 401k into an IRA, so he had more investment choices than the mutual funds offered in the 401k. He took a piece of that money, about $90,000, and bought 3 different 100,000 bond pieces of zero coupon taxable municipals that will all come due around the time he retires. I thought this was a fantastic idea. He still had a bunch of other investments and stock mutual funds in his Roth, and he was going to buy nothing but equity mutual funds in the 401k at his new employer. But he had this one little safety net that he knew was going to have $300,000 in cash available when he retired. He might be giving up a little return for a little bit of some I sleep better at night certainty. I saw him a few years ago and I asked him about those bonds. His response, I don't really pay that much attention to them. I have a website that will alert me if the credit ratings go down, but otherwise, I couldn't care less about the price movement. I know I'm going to have a nice lump of cash available when I retire, no matter what the stock market does, no matter what the bond market is doing at any point in time. Almost sounds like a sensible Dave Ramsey kind of move, right? Did you know that individual bonds can actually make money in a rising rate environment? It's true. As your bonds mature, you can reinvest at higher rates. It's like upgrading your seat on a flight for free. You can't do that with your bond mutual funds or bond ETFs. If that price is down, you're not going to be able to get out until interest rates go back down. And at that point, it's too late. You've missed the opportunity to buy bonds that could pay you more interest. If you're finding this info as exciting as I do, and come on, who doesn't get pumped about bonds? Go ahead and smash that like button and subscribe to the channel. Trust me, your portfolio will thank you. Ramsey isn't alone. We see a lot of talking heads that don't understand how powerful bonds can be, hating on them. So let's address some common objections to bond investing. First, bonds are boring. Well, so is a steady paycheck, but we all like those, right? Don't get caught up in the endorphins of the stock and option trading worlds, hoping for the next chance to quadruple your money. That's a surefire way to lose your butt. I do those things, stock and options trading, and I found I'm not terrible at them, but I don't bet the farm doing them. I keep a nice mix of index funds and individual bonds, and it's actually pretty exciting to see those account values grow. I especially like the cash that rolls in from those bonds. Next, the returns are too low. Remember, not every investment needs to be a home run. Bonds are more like consistent base hits. Remember, this is part of your portfolio, not the whole thing. Even when I retire, I'll still have some index funds in the mix, but it will be the cash generating machine of my bond portfolio that will be the main attraction. Next, I don't understand them. They're so complicated. That's why I'm here. Bonds aren't rocket science. They're just IOUs with interest. Look, if an idiot like me can make a 30-plus year career out of them, you can certainly pick them up. Some people think because you can pretty much predict what each individual bond will generate between now and maturity, that they must be missing something. Nope, they're just that simple. Check out this video playlist to get some of the basics of bond investing. If you have any questions, post them below. Chances are someone else has the same question and could benefit from additional insights. In the end, I have to say, I'm quite surprised by Ramsey's disinterest in bond investing. He talks all of the time about things that you can do to stabilize your financial world, like paying off debts, for example. However, for one of the most stabilizing investments you can make, individual bonds, not bond funds and not bond ETFs, he completely misses the mark. Probably a great example of why you should get your financial advice from a variety of sources and not just rely on one guy like him. Or me. That being said, remember to always consult with a qualified financial professional before making investment decisions. Your financial situation is unique, and what works for one investor might not work for another. See the complete disclaimer in the description below. Until next time, this is Michael O'Donnell saying, always think of bonds if you're looking for an investment where you know exactly what you're going to get and when you're going to get it.